Welcome to the deep dive. Today, we're really getting into Alphabet's Q3 2025 financials. Pretty monumental results, really. The big headline everywhere is, well, they did it. Their first ever $100 billion quarter.
Yeah, quite the landmark. The actual number came in at $102.3 billion. That's what, a 16% jump year over year?
16%, or 15 if you look at constant currency.
Right. Impressive top-line growth, no doubt about it.
Absolutely. But, our job here is to dig a bit deeper than that big flashy number. We really want to unpack what specifically powered that growth, which parts of the business are firing on all cylinders.
And crucially, set that against the backdrop of, well, two pretty significant headwinds.
Exactly. First, the absolutely massive investments they're making, especially in AI infrastructure.
Billions upon billions.
And second, the, shall we say, persistent attention from regulators, which is costing them real money in fines and forcing changes.
Yeah, it's this fascinating picture, isn't it? Incredible performance, but happening while they're absorbing these huge legal hits and just pouring cash into future bets. It shows they can make enormous profits now, but securing that future dominance, that comes at a really, really steep price.
Okay, so let's break down those core numbers first.
Okay.
Q3 2025 versus Q3 2024. Consolidated revenues, we said, $102.346 billion. Check. Net income came in at $34.979 billion. That's up a whopping 33% year over year,
Huge jump.
which drove the diluted EPS, the earnings per share, up 35% to $2.87. I mean, those are fantastic growth rates.
They really are staggering increases on the profit side, but, and this is a big but, we have to talk about that European Commission fine. It kind of muddies the water on operating profit.
Right. How did that play out?
Well, if you just look at the standard GAAP operating income number, it's $31.228 billion. That's only up 9% year over year.
Only 9%. That seems, well,
Far
just
up.
sluggish compared to 16% revenue growth.
Exactly. And that gives you an operating margin of about 30.5%. It just doesn't feel like it reflects how well the core business seems to be doing.
So why the disconnect? What's dragging that gap number down so much?
It's that fine. That GAAP number includes a $3.5 billion charge from the EC. It was related to their ad tech practices. Self-preferencing, I think was the term.
Okay, $3.5 billion. So if you pull that out,
Right. If you adjust for that, look at the operating income without the fine, it jumps to $34.685 billion. And that represents a 22% year-over-year increase, much more aligned with the revenue growth.
wow. Okay, so that changes the picture significantly.
It really does. And your operating margin ex fine looks much healthier at 33.9%.
So bottom line for you listening, that single legal penalty makes the underlying business improvement look weaker than it actually was. The core operations actually improved profitability year over year.
Precisely. It's not a core operational cost like building servers. It's an external regulatory cost. Though Alphabet does plan to appeal it, we should note.
Good point. Now, speaking of things inflating the net income figure,
Yeah.
there was another really eye-popping number. Other income expense, net. It jumped, wait for it, 301% year over year to $12.759 billion. Almost $13 billion. That can't be just from selling ads, can it?
Yeah.
What on earth is in that number?
You're right to flag it. It's a huge number and needs explaining. The vast majority of that, about $10.7 billion, came from net unrealized gains on non-marketable equity securities.
Unrealized gains, so basically paper profits.
Pretty much.
It's not cash they earn from search or cloud this quarter. It's the value of their private investments, like stakes and startups getting marked up on the books.
Exactly. So while the core business is throwing off tons of cash, this non-operational item gave a massive boost to that final net income number, that 33% jump we mentioned.
Okay, that's crucial context. So accounting for the fine in these paper games, let's get back to the actual engines. Google services, still the behemoth, right?
Oh, absolutely. Pulled in $87.052 billion in revenue. That's up a very healthy 14% year over year.
And within services, search is still king.
Still the giant. $56.567 billion from Google search and other related properties. But, the story underneath is interesting. YouTube ads, for instance, brought in $10.261 billion. And the report specifically called out growth coming from direct response ads first.
The ones designed to get you to click or buy right now.
Exactly. Highly trackable, high yield, followed by the more traditional brand advertising.
And something we've watched for years. The subscription side is really starting to matter now, isn't it? Subscriptions, platforms, and devices.
It really is pulling its weight, $12.870 billion. It shows that diversification effort is bearing fruit, primarily, they said, from paid YouTube services.
Like YouTube TV, YouTube Premium,
Right, and also Google One, their cloud storage subscription.
Okay, so search, YouTube ads, subscriptions, all growing nicely. Was there anything dragging within services?
Just a minor one, Google Network revenues, that's things like AdSense for publisher websites, actually dipped slightly, down 3% year over year to $7.354 billion.
Hmm. Suggests maybe third-party sites are seeing less, while Google's own properties are booming.
Seems that way, a slight shift.
Okay, but the real acceleration story, the one everyone's watching for the future, has to be Google Cloud.
Without a doubt. Google Cloud revenue hit $15.157 billion. That's up a massive 34% year over year.
34%. And what about profitability there? That used to be a drag.
Not anymore. That's maybe even more impressive than the revenue growth. Cloud operating income was $3.594 billion, and the operating margin jumped significantly. It went from 17.1% last year up to 23.7% this quarter.
Wow, nearly 24% margin on cloud. That is critical. What's driving that? Is it just the AI gold rush?
It's heavily influenced by AI, yeah. Growth is really coming from Google Cloud Platform, or GCP, especially demand for their AI infrastructure and those generative AI tools everyone wants.
Makes sense.
And just to give you a sense of the pipeline there, Google Cloud ended the quarter with $155 billion in backlog.
Whoa, $155 billion in future contracted revenue.
Yep, committed deals. It just shows the immense demand for their cloud services, especially AI capabilities, stretching out for years.
That backlog is staggering. It underlines the opportunity, but maybe also why competitors and regulators are watching so closely.
That's the tension, exactly. It's guaranteed high-margin revenue, which explains why they're spending so aggressively to build out the capacity.
Right. And before we get to that spending, just a quick note on the other bets. The moonshots, like Waymo, still losing money.
Still is. The operating loss there widened a bit to about $1.4 billion, but, that's kind of expected for those long-term R&D ventures. Volatility is the name of the game there.
Okay, let's pivot back to the core cash cow, advertising, specifically search. That $56 billion number, how did they grow it? More clicks or higher prices per click?
Well, this quarter was interesting. It was perfectly balanced, which you don't always see. For Google Search and their own sites, the volume of paid clicks was up 7% year over year.
Okay, some more clicks.
And at the same time, the average cost per click, the price side, was also up 7% year over year.
7 and 7. So revenue growth there was split exactly between
Yeah.
more volume and higher prices.
Exactly. Perfectly balanced, speaks to pretty strong demand and pricing power if they can raise prices 7% and still get 7% more clicks.
Definitely. Now, contrast that with the Google Network side, AdMob, AdSense on third-party sites. Different story there.
A bit different, yeah. On the network side, the volume, measured in impressions, actually went down 5% year over year.
Fewer ad views on partner sites.
Right. But they managed to offset some of that because the price, the cost per impression, went up 6% year over year. So it seems like that lower margin third-party business is seeing volumes dip a bit, but pricing is holding up okay.
Interesting. And one little detail from the report. TAC, traffic acquisition costs. The money they pay out to partners. It went up in dollar terms, but actually fell slightly as a percentage of revenue.
That's right. It dropped from 20.8% of revenue last year to 20.1% this quarter.
Why would that be?
It mainly reflects that revenue mix shift we talked about. More of the growth is coming from Google's own properties, like Search, which have lower TAC payouts compared to the network partners. So the overall TAC rate comes down. It's generally seen as a positive sign, favoring their higher margin-owned assets.
Got it. Okay, so the core business, especially Search and Cloud, is humming along incredibly well, but that doesn't happen for free. Let's talk about the investment. The CapEx numbers are, well, frankly, they're astronomical.
They really are something else. Capital expenditures, CapEx, for just Q3 2025 was $23.953 billion.
Almost $24 billion.
In one quarter.
Yeah. And that's an 83% increase compared to the same quarter last year. 83%.
Unbelievable. What are they spending it on? Servers.
Pretty much, it's heavily focused on technical infrastructure. Servers, yes, network gear, building out data centers. They are laying the physical groundwork for the AI future at breakneck speed. $24 billion a quarter isn't just spending. It feels like they're trying to build an entirely new layer of global infrastructure. How does the market feel about this level of spending? Is the return guaranteed?
Well, given that $155 billion cloud backlog, there's clearly confidence. But it's a huge bet, and they're not slowing down. Looking ahead, they forecast spending between $91 billion and $93 billion on CapEx for the full year 2025.
93 billion.
And they explicitly said to expect a significant increase on top of that in 2026. Again, almost all driven by the need for more AI capacity.
It's just hard to wrap your head around those numbers.
Yeah.
And it's not just building data centers, right? They're also making huge acquisitions to bolster things like cloud, that Wiz deal.
Right, the planned acquisition of Wiz, the cloud security company.
Right.
That's an all-cash deal for $32.0 billion, expected to close sometime in 2026.
32 billion cash for one company.
Yeah, it shows they're not just buying compute power, they're buying critical pieces like security to make enterprises feel comfortable moving to their cloud. It's a major strategic plank.
So they're spending like crazy. They're getting hit with fines. Are they running out of cash?
Not even close. Despite all that spending, they're still generating cash faster than they can spend it almost. They ended the quarter with $98.5 billion in cash and equivalents on hand.
Wow.
And the cash generated just from operations in Q3 alone was $48.4 billion.
Okay, so they're basically a cash burning machine.
Yeah.
Liquidity is definitely not an issue.
Not at all. Even with that 83% CapEx jump, they're swimming in cash, which gives them the firepower for these huge strategic moves.
All right, which brings us full circle back to those other costs, the legal and regulatory ones. We talked about the $3.5 billion EC fine hitting Q3's P&L, but that wasn't an isolated incident this year, was it?
No, absolutely not. These massive fines and settlements are almost becoming like a recurring line item. It's part of the cost of doing business at their scale. Remember that $3.5 billion EC fine is being appealed. But earlier in the year, in Q2, they booked a $1.4 billion legal accrual for a privacy settlement. That significantly boosted their G&A expenses year to date.
So billions here, billions there. It adds up. These aren't just theoretical risks. They're hitting the bottom line repeatedly.
Correct. And arguably more impactful than the fines are the mandated business changes coming from regulators. Those can fundamentally alter how they operate key businesses like search or the Play Store.
That feels like the bigger long-term threat, maybe.
It could be. You look at the US DOJ search case. The decision in September imposed actual restrictions on how Google can distribute its services, and it requires them to share search data and offer syndication services to rivals. That's a direct intervention in their core operations. Final judgment is expected later this year.
And then there's the Epic Games lawsuit about the Google Play Store.
Right. Even though Alphabet is appealing that verdict all the way to the Supreme Court, the remedies ordered by the lower court actually started being implemented in October 2025. So things like allowing alternative billing systems. Those changes are happening now, impacting their App Store model, despite the ongoing appeal. It shows these regulatory actions have immediate real-world consequences on how they make money.
So putting it all together, the story of Alphabet in Q3 2025 is really one of, well, incredible strength meeting powerful constraints.
That's a good way to put it. Extreme duality. On one hand, they are perfectly positioned, it seems, to ride this massive AI wave. You see it in the accelerating growth, the improving margins, especially in cloud and search. But on the other hand, capitalizing on that demand requires this absolutely colossal upfront investment, that $90+ billion in CapEx this year alone. And layered on top is this constant intensifying regulatory pressure, showing up as billions in fines and these structural changes being forced upon their core, most profitable businesses.
It really makes you wonder about the end game. Can regulation truly rein in a company that's innovating and spending at this velocity? They seem to be at the peak of their powers financially, yet facing unprecedented operational handcuffs.
It does raise a big question, maybe something for you, the listener, to think about. We see Alphabet pouring, let's call it $93 billion into CapEx this year, mostly for AI infrastructure that's building capacity for future growth. But then you see these multi-billion-dollar fines piling up and these court-ordered changes to how they run search and the Play Store globally. How much of that future AI-driven growth will they actually be allowed to capture and monetize freely? What's the true long-term cost, not just in dollars, but in operational freedom of maintaining that kind of market dominance in the face of determined regulators? That feels like the central tension we'll be watching play out for years.
A fascinating puzzle indeed. A company firing on all cylinders, yet constantly navigating these very powerful external forces. Thanks for breaking down such a complex quarter for us.
Always enjoyed digging into the numbers.